Gen Z gets a bad rap.
They do, huh?
Yeah, they do.
Everyone thinks they don't care about owning a home. Well, that's 100% wrong. They're saving early, working harder, and planning smarter than most people think. The problem isn't motivation, it's the market. And here in San Diego, that reality hits harder than almost anywhere. But despite that, it's not stopping them. Stick around as we cover how Gen Z is making homeownership possible and how it may affect you. Headlines are back at it again, screaming that foreclosures are surging and that the market's in trouble again.
Are you serious?
But when you actually look at the data, it's not even close to what we saw during the world financial crisis of 2008. Foreclosures are up. They're up 17% year over year, but that's off an incredibly low base. California's sitting around 11,000 total filings compared to over 500,000 per quarter during the 2010 peak. So let's unpack what's really going on here, because this is one of those moments where headlines and reality are two radically different things. Both of these topics and more covered here in this week's San Diego Market Matters, and I'm Karl Kyler, your San Diego Realtor. Now, real quick, if you want to stay up to date on the San Diego housing market, be sure to like and subscribe. And if you're thinking of buying or selling here in San Diego, my contact info is in the description below. Feel free to give me a call and let's talk. Now, on to the good stuff. Here's your quick market update for this last week. We had a lot happen. We're still working through the government shutdown, and what is hurting us heavily is the lack of labor reports. Mortgage rates held steady this week, sitting at about 6.23% for a 30-year fix, roughly the same as we saw last Friday, and still hovering just above a 3-year low. You'd think rates would have dipped this last week due to the 10-year Treasury yield finally breaking below 4%, but that didn't happen. The spread between the 10-year Treasury and the 30-year mortgage rate is still sitting around 2.2%. That's tighter than earlier this year, but still high compared to pre-pandemic norms. Normally, a drop in the 10-year Treasury will pull rates down with it, but investors are cautious right now. Late this last week, headlines hit about the bankruptcy of Tricolor, one of the country's largest subprime auto lenders and used car dealerships. That sent a small shock through the credit markets, because when subprime debts start cracking, investors pay attention. JPMorgan Chase CEO Jamie Dimon even said, "When you see one cockroach, there are probably more." Now that definitely didn't calm nerves. So while bond yields slipped a bit on recession fears, lenders didn't pass the savings along to buyers, at least not yet. It's a reminder that even as inflation stabilizes, hopefully, and the Fed inches closer to rate cuts, broader credit stress can still keep mortgage rates sticky. The takeaway, rates are holding just above 6%, and the 10-year Treasury broke below 4% for the first time in months, and the spread continues to narrow. Small moves, but meaningful ones. If the economy weakens further or the Fed signals an October and December cut, we could finally see mortgage rates drift below 6% in the near future. Now, speaking of affordability, let's move on to the next topic with regards to the next generation of buyers, Gen Z, trying to make sense of this all. A new survey of over 1,000 Gen Z adults found that 82% believe it's harder for their generation to buy than anyone that came before them. Duh. Yet 2/3 are still seeing homeownership as a lifetime goal, and nearly 70% say that real estate is the key to building wealth. They're not giving up. They're just taking the long road. Nearly 3/4 have already started saving for a down payment, aiming for about $54,000 on average, almost double last year's national average. And yes, I know in San Diego that's not that much, so keep in mind that this is a national average. So how are they doing this? It's not by chasing crypto or flipping stocks. They're grinding. 1 in 3 has a side hustle, which is not surprising considering how many side hustle videos pop up by TikTok. And 1 in 4 has plans to move, or they've already moved to a more affordable market. Fewer than 1 in 10 said that they're taking risky investments. Basically, Gen Z is skipping the get rich quick and choosing to get rich eventually. That's very Warren Buffett of them. But motivation isn't the only problem. Affordability is. Even with all that effort, only about 1/3 feel financially ready to buy. And here in San Diego, that's no surprise, with median prices around $1 million and mortgage rates where they are. It takes roughly $200,000 in household income to afford the median home. And that's not even including or counting the cash needed for the down payment and the closing costs. Even the most determined buyers are fighting an uphill battle against math.
How exciting.
here's where it gets really interesting. This kind of delayed demand builds up pressure. Once rates drop, maybe next year, maybe the year after, these prepared and patient buyers are going to start to flood the market. And when that happens, expect a new wave of competition hitting already low inventory. The big takeaway, Gen Z isn't sitting out by choice. They're strategically waiting, and honestly, they're doing it at a great time. Price growth has settled here in San Diego thanks in part to these high interest rates, and now it's actually possible to outsave the rate of growth that we're seeing in the market. If you want to see that data in detail, check out last week's San Diego Market Matters where I broke it all down. Gen Z is saving, they're planning, and they're getting their finances right. Home prices and rates are still moving, so they'll likely pay a higher price down the road, but for now, the market isn't outpacing them. So if you're in your 20s and working towards that first home, stay focused and don't wait for the perfect timing. It doesn't exist. The best move is to get financially positioned as soon as possible. Save, build credit, and talk to a lender before that next wave of buyer hits. Now, let's address the recent foreclosure headlines that has a lot of people in a bit of a tizzy.
Does anyone even use that word anymore?
ATTOM Data Solutions released their Q3 foreclosure report showing just over 100,000 properties nationwide with a foreclosure filing. That includes everything from initial notices of default, also known as NODs, to auction sales and bank repossessions. Nationwide, that's 1% quarterly increase and 17% annual jump, which sounds big until you realize how small the numbers actually are in context. Back in 2009, 2010, there were almost 750,000 foreclosure filings almost every quarter. Today's number isn't a crisis. It's a rounding error. Most of what we're seeing now is simply the slow normalization of activity from the pandemic era moratoriums that had ended. Lenders are catching up on old cases that were frozen for years, not drowning in new ones. And here in California, we ranked 12th in the nation for foreclosure filings with about 11,000 properties in process. And yes, 12th sounds high, but remember, we're also one of the most populated states in the country. 11,000 filings in California comes out to roughly 1 in every 1,300 homes, barely a blip. And here in San Diego, with fewer than 6,000 active listings total, even if every single foreclosure hit the market tomorrow, it wouldn't come close to flooding our supply. Most homeowners today have record levels of equity and ultra low fixed rate mortgages. That gives them options. If they fall behind on payments, they can sell long before the bank ever takes the home back. That's a massive difference from 2008 when millions of owners were underwater and couldn't sell without taking a loss. Now let's clear something up. Most people don't know how foreclosures actually work. When a home first goes to auction, it has to be bought in cash, no exceptions. And the reason you can't get a loan is because the title isn't cleared yet, and without title insurance, no lender will touch it. That instantly wipes out a majority of potential buyers for that one foreclosed home. If a home doesn't sell at auction, it goes back to the loan servicer, basically the bank that manages the loan. And from there, it gets listed with a real estate agent. But here's the part that most people misunderstand. It's not listed for the debt that was owed. By law, it must be listed at market value based on a third-party broker price opinion, or BPO, not the bank's estimate and not the agent's opinion. So yeah, you might find a deal at the courthouse steps, but once a property hits the MLS, it's priced like any other home. The only time foreclosures sell well under the market is when they're bought at auction, and that takes cash and experience and a healthy risk tolerance. The big takeaway is this: rising foreclosures don't mean collapsing prices. Right now, they mean that the market's normalizing after years of unusually low activity. Borrowers today are in far, far stronger positions, and the vast majority of these properties will never even reach the open market. So next time you see these ridiculous headline warnings that foreclosures are surging, remember, perspective matters. The 2025 market is nothing like the 2008 world financial crisis. Equity is high, lending is tight, foreclosure prevention systems are in place, and inventory is low. This isn't a wave, It's barely a ripple. And that's a wrap for this week's San Diego Market Matters video. If you found this information valuable, be sure to hit the like button and subscribe to my channel so you can stay up to date on all the San Diego happenings in the real estate market. And if you're considering buying or selling property here in San Diego, don't hesitate to reach out to me for expert guidance tailored to your needs. As always, I'm Karl Kyler, your San Diego realtor. I'll see you in the next video.